So we're going to continue today with Chapter 15, financial analysis, which is a lot of ratios and a lot of ways to just analyze what the financial statements and how a company is doing financially. What's the story? What makes it different than other companies? And um, different ways to evaluate its performance, its financial solvency, its profitability, liquidity. And so on Tuesday, we went over liquidity and solvency. Liquidity being short-term ability to pay debts within a current year. Solvency, ability to make long-term obligations as they come due in the future years, like as for example, long-term debt. So we had times interest earned ratio, um, and debt to equity ratios. Liquidity ratios being like current ratio, quick ratio, because those are abilities to make short-term obligations and also working capital ratios. We talked about days in accounts receivable, and the cash-to-cash cycle, where companies can maximize their working capital efficiency by collecting payments earlier and delaying other payments, and also managing inventory effectively. And now we are going to get into profitability ratios, and it analyzes a company's ability to generate future earnings. And it depends on the relationship between a company's operating results and the assets the company has available for use in its operations. And it's it's really important that we're analyzing both. I mean, we can analyze a profitability metric could be a profit margin or a gross margin, but taking a look at how that relates to operating assets available for use is a good indicator of how effectively will a company be able to use new investment to make even more money. And that's what investors care about a lot as well when they're investing in a company, to give it more funds. Like, what are you going to do with it? And so uh, we have asset turnover and return on total assets. These are uh, asset efficiency ratios. And then we have return on equity metrics, such as return on stockholders' equity, return on common stockholders' equity, so excluding the preferred shareholders, and then earnings per share on common stock. Then we also have price to earning ratio and dividends per share, and then dividend yield as investment metrics as well. And this gets into, a lot of the things that investors care about. I think Shark Tank is just such a good example for this, for financial statement analysis, because it's a 5-minute show segment where the sharks are taking a look at a business, seeing whether they want to invest. And right, the profit margin stuff and the gross margin, right, was what do you buy it for, what do you sell it for? And then these asset turnover ratios and return on equity ratios, it's more like, okay, well, how much money are you asking for and what are you going to do with it? Because these so we can get right into asset turnover. Asset turnover determines how capital intensive a business is. It's sales divided by average total assets, which we can also take to assume if we're investing more in to grow assets of the business, equity has to grow, which means investment from shareholders, or debt has to grow in order to grow the assets of a business. And the asset turnover ratio takes a look at the relationship between sales and total assets. And, a higher asset turnover ratio is better. And then this also, asset turnover ratio and return on total assets. Return on total assets is net income based, and then asset turnover is sales based, but it's basically how efficiently is a company using the assets. And the more efficiently a company is using its assets, the more sales dollars will be created by investing more total assets. So that's a really good way to look at and interpret. There's two ways to interpret it. It's how efficient are they using the assets they have? And if we invest more assets, for example, this company has an asset turnover ratio of 1.4. So if they get another $1.4 in assets, they're estimated to generate another one. If they get another dollar in assets, they could generate another $1.40 in sales, is how we could look at this. And of course, uh, um, and of course, there's other factors involved too, right? Like that's not a pure way to forecast. If more assets are invested, then that's how it's going to generate more sales. But it's a good way to look at and interpret the metric for sure. And it is a good approximation. And that we exclude long-term investments um, from this metric. And that's because they're not related to generating sales for the most part, right? If we think about investing in assets to generate more sales, that's investing in more property, plant, and equipment, more inventory, more um, operating assets of the business. Long-term investments are, investments either separate to the business or as a subsidiary. For example, when we looked at Altria and their purchase of their investment in Juul, right? If they're investing in Juul, that's not providing more sales for Altria or Marlboro cigarettes, right? But they invested in Juul as a strategic long-term investment for the future. But that's not driving more sales, and so we're excluding that from our metric here. So that's just important to note. And we take average beginning of the year divided by the end of the year, or beginning of the year plus the end of the year divided by 2 to get the average. I mean, and then return on total assets measures the profitability of the assets. It's expressed as a percentage. Um, and so we take net income plus interest expense divided by average total assets. And we add interest expense to net income to make sure that we're not um, taking into account, we don't want to be biased by whether the assets are financed by creditors or stockholders. Because when looking at return on assets, um, if we're issuing debt to purchase more assets, generally we would like the interest rate to be lower than the return on assets. Because if we're purchasing assets to create net income, we want the income to be more than the additional interest expense. Um, Now that can be on a project level, right? That's all a marginal. We want it to marginally be better. But when we're looking at return on assets, we want to look at the percentage return that we're getting on assets. So net income divided by average total assets. We add back interest expense so that we're not punishing high debt companies unnecessarily. And also because a lot of time this is looked at by bondholders and they want to look at it pre-interest expense, pre-debt expense, essentially. So to get return on assets, we take net income plus interest expense, $97,000. We get our average total assets. And then in 2026, it was 8.2%, 2025, 7.3%. So um, note how net income before interest expense increased by about 10,000 and then total assets decreased. And so then that both contributed to increasing um, total, return on assets. Excuse me. there's also an additional metric, return on operating assets, and that's operating income divided by average operating assets. Um, Once again, we had the sales turnover metric was total sales divided by total assets less long-term investments. Operating return on operating assets is trying to approximate the same thing. Um, so we just only divide it by average operating assets, and that'll be assets used in the operations of the business, plant, property, and equipment, supplies, inventory, accounts receivable, accounts payable, not long-term investments, goodwill, etc. So, um, and all of these metrics, right? We have different metrics to tell a different story. And sometimes the story is how do I make right? Sometimes it's investors or like sometimes it's management of the business trying to make the business look good from a particular lens. Sometimes it's financial analysts trying to actually paint a picture of a particular business, of a particular industry. And every industry has different metrics for that are particularly important to an industry. For example, airlines uh, calculate a lot of these metrics per available seat mile of the airline. So if a plane has 100 seats, flies 1,000 miles, it calculates the like cost per available seat mile, revenue per available seat mile, profit per available seat mile. It's all reported in these companies' earnings statements, and it all gets fairly specific. Um, Return on operating assets would probably be for a company that's operating assets are important to the business and is what's driving additional income. And they're saying, okay, we need more assets or look at how efficiently we're using our assets to generate income. Um, I would think it's a fairly industry specific metric. Return on assets, return on equity are definitely more used metrics when analyzing this stuff. So return on equity is one of the most important um, investor metrics, in my opinion, because it is the return on it essentially will show that without any additional dividends or new investment, this is how much equity is going to grow by every year in the business. And so we take net income divided by average stockholders' equity, and it's the ratio of income earned on the amount invested by shareholders. And it also, in my opinion, return on equity is the main source of earnings per share growth. Because if a business has a stable return on equity and they're not paying out all the dividends every year, equity is slowly going to grow. The total equity balance is going to grow. And then if the return on stockholders' equity remains constant, net income will grow because total equity is growing. The percentage of net income of total equity is growing, right? So then net income is also going to grow over time. And so the net income is sort of growing at a compounding rate. Um, so return on, especially in growth companies, return on equity is usually quite high. And in value stocks, it's usually relatively lower. However, it all of course depends. And so how we can compute return on equity, right? We just take net income of 91,000 divided by 1.6 million, and we get average stockholders' equity of 808, and then return on equity of 11.3%. Um, and it really is showing how much of a return the equity portion is getting. What's the return on investment of the equity that's been invested in the company? And of course, the the total stockholders' equity is also known as the book value of the company. Um, if the company's return, I don't know. So that's just important to note that that's the return on book value or return on equity, and it's a really common shareholder metric. And so leverage involves using debt to increase the return on an investment. And right, return on equity is always going to be higher than return on assets because return on assets is net income divided by assets. Return on equity is net income divided by average total stockholders' equity. And right, equity is only a portion of the total assets. So return on equity is going to be higher because the denominator is smaller. And that's because of the effects of leverage. Because some of that was financed by debt, the debt is going to amplify the return. So if we have a leverage involves using debt to increase return on investment. Return on stockholders' equity is normally higher than return on assets. For example, return on assets is 8.2%. Return on equity is 11.3%. So the effective leverage was 3.1% or 2.7% respectively for Lincoln Company. And this is a really simple analysis of the effect of leverage, but we'll go into the DuPont method of analyzing the effect of leverage in just a bit here. But essentially, I mean, the reason companies take out debt, I don't know, you've probably seen people on YouTube or the internet where they're like, I mean, people just screaming to buy real estate with large amounts of debt and then rent it out, right? It's free real estate. That's why companies do it though, right? They take out debt, invest it, make more than the interest. That increases shareholder returns because it increases return on equity based on they made more money than the interest. Of course, leverage works both ways. If they lost money, then they would lose even more money because they took out debt and the money they lost was not their own. So we can also compute the return on common stockholders' equity by taking net income, subtracting the preferred dividends, and then dividing it by average common stockholders' equity. And this can either be more or less than return on than the regular return than the return on total equity based on the right net income is less because of the preferred dividends, but the denominator is also less. So depending on the effect of both of those, return on common stockholders' equity could be greater or less than the total equity return. However, it's a much better metric for common shareholders and companies with a lot of preferred debt, which almost was a topic no one cared about anymore until I think I just saw it come up in the news this week with MicroStrategy. They're a company that essentially they raised a bunch of money to buy Bitcoin on the company's balance sheet, and that's the whole strategy. The whole is just a company that buys Bitcoin as sort of they're a Bitcoin treasury company. It's a meme stock. They're just trying to buy Bitcoin, but then they ended up issuing a whole bunch of preferred stock as well as common stock. And then now they're trying to issue more stock to make the preferred stock dividend. If I had a slide for it, it would probably look like a pyramid. But essentially, preferred stock, it can make things complicated, and it's important to look at the returns for common shareholders specifically when looking at, when analyzing common stock and investment in common stock. So For this company, Lincoln Company had a $150,000 par value, 6% preferred stock. So the preferred dividends is 9,000, 150,000 times 6%, and that's every year. And so Lincoln's common stockholders' equity is determined as follows. We're only including the common stock $10 par and the retained earnings amount in the common stockholders' equity. We're not including the $150,000 in preferred equity. And then when we calculate the net income, we have to take the preferred dividends out of the net income before we calculate. And so the return on common stockholders' equity is 12.5% and 10.9%. And it's interesting to note, I do think that's higher. I do think that there's a higher, right? Return on stockholders' equity was 11.3% for total equity and 12.5% for common equity. And my first impression of this is that's because the preferred dividends are at 6%, but the return on total equity was greater than 6%. And so that's preferred stock acts as as a hybrid between equity and debt. And so it essentially is taking on more leverage to increase return on common equity. And so if we we can take a look at the effective leverage by taking the return on equity, subtract the return on assets. That's the effective leverage. Preferred shares are also a type of leverage for this company. And so if we took the return on common stockholders' equity subtracted by the return on total equity, that like 1.2% of additional return on common shareholders' equity, that's the effect of the preferred shares because they're paying out less than their return on that capital. So once again, there's the differences here between return on total assets, return on stockholders' equity, and return on common stockholders' equity. And return on total assets, that's just total capital intensiveness and capital efficiency of the business. And then return on stockholders' equity and common stockholders' equity, that's the efficiency of the shareholders' specific use of the capital. So we're separating it in how, for different stakeholders that we're reporting to, everybody cares about different things. And nobody, the common stockholders are going to care the most about the return on common stockholders' equity. Large new investment is probably going to care most about return on total assets to make sure that the new investment is going to drive additional growth, additional sales, and additional net income. And there's a really interesting formula that we can use to analyze this as well. It's called DuPont return on equity. And DuPont is a chemical company, but it was also a person. And this person was a very savvy investor and basically expanded out the formula for return on equity. Return on equity is net income divided by average total equity. And this expands it to find what's driving return on equity in a company. And it's really interesting. So we could cancel this whole formula out into net income divided by average total equity because revenue would cancel out, average total assets and average total assets was coming out. However, these are three separate metrics that are all individually important metrics to the business. Net income divided by revenue is profit margin. Revenue divided by average total assets is asset turnover ratio, and then average total assets divided by average total equity is a debt ratio. How much debt does the company have? And we can use it to compare companies and compare years. For example, Superco had a profit margin of 10% in year one, 12% in year two, asset turnover ratio of 2 in year one, 2.08 in year two, and then financial leverage of 2.5 and 2.4 in year two. And so if we take 0.1 times 2 times 2.5, we get return on equity of 50%. And we can see that return on equity increased from 50% to 60% year over year. What mostly drove that change? A large 20% increase in profitability and a small increase in asset turnover and a slight decrease in financial leverage. And in my experience in auditing, analysis like this is extremely important to find what actually drove the change. And auditors aren't looking at return on equity, but they are looking at increase in sales in a particular region, increase in cost of goods sold in a particular region, increase in net income in a particular region, particular industry, particular business segment, and being able to separate year over year, where did the change exactly come from, builds a lot stronger narrative and a lot stronger understanding of why is this business actually changing, and where should we investigate what changed. For example, and so this, from an investor's perspective, is really useful to figure out what's driving increasing or decreasing return on equity. From an auditor's perspective, it would be, what do we need to test, right? If net income decreased by half year over year, but sales remain the same, that means expenses increased by a lot. There probably would be a lot more testing of expenses, not as many testing of sales, because the expenses is what was different than what we expected. So it's all about, for example, this also shows the effect of financial leverage on a business too in a lot clearer way. So Gear Inc. Incorporated, year one return on equity was 42%, year two was 60%. Nothing about this business changed whatsoever, except for equity decreased by 1,500 and assets remain the same. That means equity decreased by 1,500, debt increased by 1,500, and return on equity spikes from 42% to 60% because there's less equity in the business. The effect of debt, the financial leverage ratio or the debt ratio goes from 1.75 to 2.5. And so huge returns increases can be driven by financial leverage, assuming that the returns are reliable and sustainable enough to make the debt payments as they come due, right? Yeah. If you're interested in financial analysis and value investing and metrics like this, I highly recommend The Intelligent Investor by Benjamin Graham. That's what kind of got me into this investing metrics and things like that. It's Warren Buffett's recommended book on value investing because that was his college professor. I think I actually took it out from the Anoka Ramsey library in my first semester here, or maybe it was the Anoka County Library. I'm not sure, but there's books out there. And also, I'm pretty sure it's free on the internet too. So it takes a lot of look at the fundamentals of the business, what's driving profitability, right? We have profit margin, how profitable is the business as a whole, like as a percentage of sales, how efficiently are they using the assets or how capital intensive is it, and then how much debt do they have or how much leverage are they using. So now earnings per share on common stock is another really common metric. And the formula is net income minus preferred dividends divided by shares outstanding of common stock. And I'm sorry about the size of that there, but essentially it's net income available to the common shareholders divided by the total outstanding common shareholders. And if you remember, there's three classes of shares that a company can have. I get not classes, states or numbers of shares, because there's shares authorized, right? The board votes to authorize the shares. Then the company issues the shares. So there's shares authorized, shares issued, shares outstanding. And then difference between shares issued and outstanding is the share buybacks, it's the treasury stock. So we only take it on shares that are outstanding. We don't count treasury stock in this. And the common stock outstanding, you can find this on any company. They'll report it every quarter when they issue their quarterly filings. It'll say fairly close to the first or second page, shares common stock outstanding as of the date of the filing was 50,000 shares or 17 million shares or something like that. So net income minus preferred dividends divided by shares of common stock outstanding, and we get earnings per share on common stock. And we do take an average earnings per share. It is taken on average shares during the period. It can, as a simple metric, it can be as simple as this. It can get more complicated if there are stock options that aren't technically outstanding, but they're about to be exercised. And so do they count as outstanding or not? And so we have to calculate what's the share price, what's the value of these options? What's the likelihood that they're going to be exercised? If there was a stock split, that goes back as if it happened at the beginning of the period. Same as a stock dividend. And that's all stuff that you'll get into in intermediate 2 accounting when you guys take that, which usually will be like junior or senior year in an accounting program. You'll take intermediate 2 and there'll be a week where you go into all of the intricacies of earnings per share, like weighted average earnings per share calculations. I think it's an interesting unit, and it's definitely something that's on the CPA exam. So that I think, but for simple purposes, we calculate earnings per share, and it's a really important and understandable metric to investors. And I think it's the most popular. It's probably the most popular metric for looking at a stock, share price and earnings per share, then that gets you the price to earnings ratio. I think that it's just so understandable. You don't need to understand accounting to understand, oh, hey, the share costs $10 and there's earnings per share is $1.64 per year. That's much easier to understand with finance knowledge, zero accounting knowledge. I think that getting into crazy DuPont return on equity, it takes a little bit more of an accounting mindset. So that's why earnings per share is just so popular as a metric for stocks. And then price to earnings ratio is the market price per share of a stock divided by the earnings per share on common stock. And it's a valuation metric of the business because if the market price is greater for the same amount of earnings, then if earnings don't change, right, the expected return is less. But generally that indicates that the company is expected to grow. And if price to earnings ratio is smaller, generally it's more value-oriented stock. Maybe earnings either aren't expected to grow as much or the earnings are much more risky, right? They might go away. And so we take the market price of the stock divided by earnings per share, and we get the price to earnings ratio on common stock. And interesting thing to note is you can actually look up for ETFs, broad market ETFs, you can figure out the average earnings per share of the S&P 500 or any other group of securities that you're interested in by looking up an ETF and figuring, like, they'll disclose the earnings per share of all their holdings And in my opinion, that's the easiest way to look up the earnings, like the average earnings per share. And a more they ETFs publish their holdings every day, and so these metrics get updated quite often. So that's what I use when I'm researching some of this stuff. And dividends per share also really important. It's dividends per share equals dividends on common stock divided by shares of common stock outstanding. Um, so, I mean, dividends per total common stock dividends on the financials divided by the per share amount. That's how much each share is going to get. And we can use that to, so for example, if dividends were 40,000, total shares outstanding is 50,000, that's an 80 cents per share dividend. And this graph includes both earnings per share and dividends per share. Um, so earnings per share is $1.64, and then payout of 80 cents in dividends. And then before it was $1.35 per share in um, in earnings per share, and then 60 cents in dividends. And this also, this metric isn't on the slides here, but this really demonstrates what's called a payout ratio. And um, investors really like looking at a payout ratio. So the payout ratio would be the dividend divided by earnings per share. The dividend per share divided by earnings per share, or it would be total dividends divided by net income available to common shareholders. It's going to provide the same percentage because it's either per share or they're both in total. And it just shows of the company's earnings, what percentage of that is getting paid out to shareholders. And financial analysts really like to look at this metric because it determines how much a company is going to grow. If we go back to return on equity, a company's return on equity is what drives its earnings and what drives its growth. If the payout ratio is 0%, earnings is probably going to grow by the return on equity percentage per year. It's going to compound at that percentage. Because equity is going to grow at that, return on equity is stable, so then it would grow at that amount. If the payout ratio is 50%, then earnings would grow at 50% of return on equity because equity is growing at 50% of net income because 50% of it is getting paid out in the payout ratio. So that's another common metric. Dividend yield. Dividend yield is dividends per share of common stock divided by the market price per share of common stock. And it shows what's the percentage dividend that's going to be provided on a share. And it is a really easy way to understand how big the dividend is and compare it between companies. And I think it's even more commonly talked about, well, what's the dividend yield as opposed to what's the actual dividend amount for a share price, right? The yield is what investors actually care about because that's what's providing an income. And for example, in 2025, the price was lower, so the yield was higher, but then the dividend grew by 20 cents, but the share price grew by even more, so the dividend yield dropped to 2%. So, once again, the companies in the type of industry highly affects what measures are used. Um, for example, there's airlines use revenue per available seat mile, cost per available seat mile. Hotels use occupancy rates. Real estate, a lot of times we use cost per square foot, rent per square foot, things like that. So it's all to paint a picture of how to measure a company's operations, how to measure a company's financing. And a lot of times the financing metrics are the same because there's only so many ways to take out debt. But the operating metrics like revenue per available seat mile, cost per available seat mile, a lot more important. And they tell you a lot about a company because Delta has the highest revenue per available seat mile because they're the most expensive airline. Spirit and Sun Country, much less revenue per available seat mile. And then it comes down to how well are they managing their costs, to how much money are they going to make. Um, so as a summary of we had a number of measures here. We had liquidity, the following liquidity measures, all related to working capital and ability to pay short-term debts. Then we had solvency, which is long-term debts, and how leveraged is a company, and especially times interest earned ratio, and profitability measures, mainly asset turnover, return on equity, earnings per share, dividends per share, and dividend yield. And for annual reports, public corporations issue annual reports summarizing their activities for the past year, plans for the future. They always include the following sections, and this is uh, they usually include the following sections: corporate social responsibility report, excuse me, is still optional. But the other three, management's discussion and analysis, report on internal control, report on fairness of the financial statements, the actual financial statements, that's all mandatory. It's all standardized. Um, could say so much more about it, but I want to go into the activity. But it's all every 10K is going to be the same, formatted the same. Every single one at the top is going to have mine safety disclosures, which is hilarious when you're looking at the Cheesecake Factory. Um, and it'll just say not applicable, but they're all formatted the exact same. Um, and it actually makes it really easy well, to access them with computers and like APIs. You can build a report that would scrape 10Ks quite easily. If you're interested in that, I'd look into Edgar and Edgar, XBRL. Edgar is the website, XBRL is the format, and it's a bunch of XML files that point you to exactly where in the 10K you want to go. Um, and then management's discussion and analysis, that's typically before the financial statements, before the auditor's report. It gives a full summary of the analysis of current operations, plans for the future. A lot of times they'll talk about all the different properties they have, all the different segments of their business, what's growing, what's not growing, what are the main challenges that they have. Usually, the financial statements are much more conservative in their language. They're not going to be making any bold claims in the 10K because there's a certain level of truthfulness and reliability that's required in these financial statements. Not that the earnings release in general, like there's a lot of regulations on how true that has to be too, but they can go much more on a limb with forward-looking statements, is what they call it. This is what we think our earnings is going to be next year. But they'll talk about their strategy and all the changes. They just won't make forward-looking statements about the financials in the 10K. Management's discussion and analysis. Report on internal control. Sarbanes-Oxley requires a report on internal control and management. It states management is responsible for establishing and maintaining internal control, and it has management's assessment of internal controls over financial reporting. It requires a public accounting firm to verify management's conclusions on internal control. Note that the accounting firm isn't actually implementing internal control. That's management's job. They're not creating a unique opinion on the internal control. That's management's job. They're simply verifying management's opinion on internal control. That's the auditor's role. And The under SOX, their Sarbanes-Oxley is also known as SOX. The CEO and the CFO are required to sign that everything on the financial statements is true, which also includes this report on internal control, meaning that they're required to sign every quarter that their financial controls are okay. And if they're not okay, then they've said that in their 10K. So, um, you can only imagine how many internal controls consulting fees were generated in the years after 2002 when everybody was setting this stuff up because it's a huge undertaking to set up internal controls for a large public company. Report on the fairness of the financial statements. That's the auditor's report. We've taken a look at a couple of those throughout this course, and it is the CPA firm that conducts the audit, renders an opinion, and it says that the financial statements represent fairly the results of the financial position, results of operations, the cash flows. That's called an unmodified or a clean opinion. A clean opinion would be the slang. Unmodified would be the regulatory language. And then ESG reporting. It's not a current requirement of the United States. It was so close to being a requirement of the United States, and a lot of public accounting firms were preparing big time for the implementation of these requirements. And then in the last years, due to policy direction changes, the SEC stopped developing these rules, and there's no real plans to develop new ESG rules. I think the European Union also is not requiring these ESG reporting rules. And again, this isn't requiring companies to be green, it's just requiring them to be reporting on ESG. And ESG is environmental, social, governance. So environment is what, I mean, that's I think what everybody thinks of is the environment and how like reporting on carbon emissions and things like that. But also this relates to a lot of social things. That's the most common one companies run afoul of would be unions. If they have bad union relations, that would show up on an environmental social governance score. Also, weapons, firearms, tobacco, defense contractors, that would show up on the social score, but not the environmental score. Governance is all about board governance, shareholder involvement, um, and internal controls. Is the company sort of run well from an owner's perspective? Are the directors, which represent the board of directors represents the shareholders. Governance is the process of running a business from an owner's perspective, not from the chief operating officer, CEO. That would be operating the business. Governance would be the board of directors. How good is that? Um, yeah, once again, they proposed new rules. They dropped that proposal in the last year or so. Um, so now we can get into the group activity. We still have 20 minutes left. Um, so if you could remind me what section each of you chose. I think row two is energy. What uh industrial, what were you? Okay. And real estate, what were you guys? Were you here? Okay, you can and then the back row, what was the choice? Okay, so you guys can choose. Basically, we're going to pick you can, you guys can pick any one of these and just look up we're going to look up these metrics here. So just decide two companies in your row. If you have a large row of people, you can choose more. Um, Look up the financial statements and compute these metrics. And then we'll take about 5 minutes to do that, and then we can discuss. So, okay, that's perfectly fine. We didn't actually go over anything other than sort of an intro to like what this what this activity will be.
Down.
Yeah. So I your you can work with your partners here. They in the energy industry. So you'll look up any of these four companies here. So Chevron, ConocoPhillips, ExxonMobil, Williams, and then um, look up their financial statements so you can compute these metrics and then compare them between the two companies. And once again, look up the most recent 10K. So that's full year financial statements.